Yes. So we'll get on with the rest of the chapters. So basically recapture, right? So the third point after point one and two, okay, there are 2 points which we discussed last class on post filing adjustments. These are tax has increased or decreased, and in case of tax rate changes, what would be the post filing adjustments? Now, the third instance is recapture rules. Now, what is this recapture rules? I told you in the previous class itself that the tax could be recaptured. Now, what are the instances in which tax would be recaptured? One, in chapter number 2, we discussed that current tax recapture could happen when you put accrued, you put an accrual as a tax expense, but if it is not paid within 3 years, you have to recapture. Yes or no? The cover taxes. Same with deferred taxes also. Okay. Now, if there are deferred tax liabilities basically, which is not reversing in 5 years, you will be recapturing it. You remember this? And there were a lot of exemptions also. Say R&D, then uh, if you are any maintenance, like if you're till the land and after that you give a provision, no, for re-maintenance of the land, refurbishing of the land, all those things, that was given as a exemption. You remember? Recapture of 5 years. Now, what if this instance actually happens? You put a cover tax, but you didn't pay it off within 3 years, or you put a deferred tax liability in your DTA and it did not reverse in 5 years. Then, what is the post filing adjustment that you have to bring in? Okay, so let's understand. So, current tax recapture. If the current tax expense included in covered taxes is not paid within 3 years, it must be recaptured. Right? This is something which we learned in the previous class. Only applies if the unpaid amount exceeds 1 billion. Okay, if the aggregate unpaid amount is exceeding 1 billion, then only you kind of do this recapture. So processes, let's say at the end of year three, assess unpaid tax. If it is more than 1 million unpaid, then recalculate year one ETR, including unpaid amount, any incremental terms. Okay. So what they are trying to say is, if there is a recapture, hmm, if there is a recapture, then if it is basically, how does a thing get recaptured? It is not paid within 3 years, or if it is not reversing within 5 years, as the case may be, then recalculate the ETR. Recalculate the ETR of year one, or whichever year this expense was put to, and whatever is the new top up tax or additional top up tax, net top up tax, you will pay in year of discovery. Is it clear? Let's say that you kind of recapture something, you have to track. Okay, whatever is put as a tax expense then is recaptured. If it is not recaptured within 3 years, then you have to recalculate the ETR, or if it is recaptured, then you have to recalculate ETR and pay in the year of discovery. Okay, the net tax you have to pay in the year of discovery pertaining to year one. Is it clear? Recapture. There could not be a different scenario than this. Recapture is only one way. That is, it could only result in a decrease, not an increase. Okay, there won't be any other instance where something would be added up that year. No, it will only be decreased from that. Is it clear? So let's read. Okay. So timeline, year one, let's say the current tax expense is 5 million included in cover taxes. Year four, only 3.8 million of that is paid, and 1.2 million is still unpaid. What do? Recalculate year one ETR excluding 1.2 million incremental top up tax paid in, and Basically, what is the incremental top-up tax? You pay it in year 4. Is it clear? You have to track the unpaid portion and you have to recalculate. Yes, no. Okay. Now, deferred tax recapture. What is deferred tax recapture? 4.4.4 is basically if it doesn't reverse within 5 years, deferred tax liability, then you have to recapture. So, if the DTL does not reverse in 5 years, recapture applies. So, it's a little distinct, like, the recapture period of current tax is 3 years. We'll take a moment to revise this also. It's 3 years. Deferred tax, it is 5 years. So there is a threshold. If it is more than 1 million, then only the current tax recapture on unpaid portion applies. Okay, in the previous example, it was 1.2 million. That's why it was recaptured. Okay, if the payment is made, say 5 million was put as current taxes, but I paid 4.5 million, then you don't need to recapture the 500,000. And deferred tax, there is no threshold like that. Any amount, you have to recapture if it's not reversed within 5 years. And there are no exceptions. Here, there are some recapture exception accruals. That's the list that we learned that. Yes, some R&D, some maintenance expenditure, etc. There are some exemptions to 5-year recapture. Not all details will be subject to that. Clear? Oh, now comes your very interesting bit. So is it clear, like recapture rules? Fourth one is TP adjustments. Okay. Fourth one is TP adjustments. Your most favorite kind of adjustment. So let's say sometimes there could be TP adjustments. Yes or no? Government would do a TP audit and they would say, okay, this is not arm's length, this is arm's length, you have to revise it. This could happen. Can it happen? Because the TP that calculations that mostly like companies do, it's not very reliable. It's on some data which we kind of think that it is compared. Correct? So government always, this is massive. No, you tell me, TP adjustments, it could go 4 ways, not 2 ways. You tell me how. I'll tell you. So, what are the kinds of TP adjustments that happen? One kind of TP adjustment is unilateral adjustments. See, TP is basically on a cross border setup. Yes or no? Right? So, TP adjustments, the problem is all these adjustments have two phases, and this one only has one phase. But TP unfortunately has four phases. You know how? One phase is, or one is basically tax can increase or decrease, correct? So tax can increase or decrease. That is, okay, this is not working. So four phases are like, tax can increase. Just give me a second. Yes. So, you guys are ready? Okay. So, TP adjustments, I told you there are four phases. So, what it is like, it could be a tax increase, it could be a tax decrease, right? TP adjustments comes out and say that it's a tax decrease for you, right? But simultaneously, what will happen is if your taxes increase, then since it's a two-way transaction, you are transacting with a related party. If your tax increase, that means the related party's tax decrease. And if your tax decrease, then the related party tax increase. So that's why I told you there are four phases to TP adjustments. Okay, so just understand that TP adjustments are like, because see what adjustments you do in your books with respect of that transaction, simultaneously the RPs would be affected. So in both cases, there is a parallel inverse shift in the related parties transactions as well. Okay. Now there are two types of TP adjustments: unilateral adjustments and unilateral adjustments means only one country jurisdiction, only one jurisdiction making the change, right? Then it would be only two phases, but it could be bilateral also. Both jurisdictions combined. See, you have to understand that it could be multilateral also, because not just it's not between you and your related party directly, but between your PE and the related party's PE. In such a situation, there would be four countries coming into the purview. You understand the point? The complexity in TP adjustments. Yeah. So let's understand in case of TP adjustments what we should do. Okay. So transfer pricing adjustments. So Globe respects transfer pricing adjustments made by local authorities. So whatever transfer pricing adjustment we do, we definitely respect it. So unilateral adjustments are generally accepted. Corresponding adjustments ensure no double taxation. So that is the whole thing. Corresponding adjustments would kind of recreate. So I told you there are three types of adjustment. Multilateral, let's leave it for a while. There is unilateral adjustment. What is unilateral? When country A's tax authority makes a TP adjustment. Okay. So if country A is higher tax, so what do you do have to do about globe is if country A is higher tax, adjustment reduces country A's expense, then increase country A's globe income, corresponding increase in country B's globe income. Okay. If the country A is under tax, no corresponding adjustment in country B prevents artificial reduction of low tax income. So what they are basically trying to say is, if country A is higher taxed, okay, country A is where the TP adjustment is happening, and country A is higher tax. Higher tax meaning it is more than 15%. Adjustment reduces country A's entity's expense. Now, if the adjustment reduces entity's expense, then what happens? Is it a tax increase for the prior year or tax decrease for the prior year? Adjustment reduces country A's tax expense. So it would be a tax increase or a tax decrease. It would be a tax increase because we are reducing the expenses. Then you have to increase country A's globe income. Absolutely. Right. If the reduces the expense, then increase country A's globe income and corresponding decrease in country B's globe. If it is higher taxed, then you have to do both the changes. But if it is under taxed, then no corresponding adjustment in country B prevents artificial reduction. So either way, you have to do an adjustment to globe income also, not just taxes. This time there would be an adjustment to globe income. So both the numerator and denominator will change in recalculating ETR. See, the concept remains the same. If it is increase in taxes, then whatever is the additional taxes, you kind of give it a leeway in the year of discovery. But if it's tax decrease, the recalculation, you would have to take both. You have to recalculate not just the cover taxes but also the globe income, because income is what is being a transfer pricing adjustment definitely does not impose or taxes, but they kind of allow or disallow income. So the globe income should also be recalculated. Okay. So, just to kind of post filing TP audit increases tax in year one. Okay. So, it increases tax in year one and this is discovered in year three, then add to year three cover taxes. Okay. TP audit decreases tax in year one, then recalculate year one ETR. ETR both globe income as well as cover taxes and additional top up tax in year. Now, if bilateral APA is applied, then adjust adjust as per APA terms, follow the recalculation rules. Whether it will result in increase or decrease, based on that, you have to recalculate. Now, it's a self-initiated. See, basically, depends on the timing, but the understanding remains the same. If it is increasing your taxes, then you can only add to year three cover taxes. If it is decreasing the taxes, then you have to recalculate the top up tax for you. It remains the same. But for the corresponding jurisdiction, you have to see whether you are higher taxed or under taxed. If you are higher taxed, then only corresponding adjustment is allowed. If you are under taxed, then no corresponding adjustment is allowed in country B. Is that clear? Hmm? Now, when I say that this happens in both the countries. Okay, for one it is increased, then other it is decreased. When one it is decreased, then the other it is increased. You can change the cover taxes, but the numerator has to be changed in either case. But the denominator will only change when country A is higher tax. Is that clear? Okay. So this is something that is a little different. Then audit settlement. So this is basically like government conducts an audit and if there is settlement. So let's say that German tax authority audits MJ Germany for financial year 2024. Now assessment is issued in FY 2027 saying that additional tax of 800,000 has to be paid. So what do you do? What do you do in this case? You tell me. What do you do in this case? What do you do? Now you have to tell me what exactly I should do, not increase or decrease. What would you do? So German tax authority audits the company and it issued an additional tax of 800,000 pertaining to 2024 in 2027. What do you do? Why are we not getting any charge? Convert tax increases in financial year 2027 for 800,000. Absolutely. So add 800,000 to FY 27 cover taxes. No recalculation of FY 2024 and no amended G. Why no recalculation of FY 24? Because it's a tax increase. Right? Tax increase, no recalculation. Only add it straight away to the cover taxes. Now, tax authority audit resulting in a refund. So, Irish Revenue audits SG Ireland for FY24. Refund issued is 600,000. Now, what you do? So, assuming that the 1 million threshold is not met, 1 million of recalculation threshold. If material election is made, then reduce 2027 cover taxes. If no election, recalculate FY24 ETR. As simple as that. This is basic application of increase or decrease. Okay, so tax authority gives you an additional tax, add it. If it gives you a refund, then you have to recalculate ETR of 2024 if you are taking a immaterial election. If you are not taking an immaterial election, and if you're taking an immaterial election, then we learned about immaterial election yesterday. Threshold of 1 million, aggregate taxes in the jurisdiction. Then you kind of like, so it's as simple as that. Okay. So basically, like, to put our notes, there is tax increase or decrease, then I think we are clear about what is the treatment. Tax rate changes, then your deferred tax liabilities has to be changed to the new year, subject to a cap of 15% or the domestic rate, whichever is minimum in case of an increase. If it is a decrease, then you have to recap. Okay. Now recapture rules. If there is if there is a recapture because within 3 years the cover tax is not paid, or there is a recapture of DTL because in 5 years it has not reversed, then you have to recalculate the ETR of the year in which these were included as adjusted cover taxes, and you have to pay the additional top up tax in the year of discovery. Clear? TP adjustments result in a twofold. The adjustments on increase and decrease is the same, but you have to understand that there would be an increase, there would be an adjustment to globe income also. And globe income change should only be done if, the changes are to the higher tax jurisdiction. Okay. And finally, like, TP adjustments, and then we learned about audit adjustments, which is basically the same as increase. If it is an increase, then you have to add to top of taxes in year discovery year. And if it is a decrease, then recalculate ETR of prior year, or like, you can take an election for 1 million threshold. Is this clear? What are the adjustments, post filing adjustments? Yeah. Now let's do this question. I will do it this time. So let's say Germany. Germany, has a tax audit assessment which results in a 750,000 euros increase. What do you do? Simple. And they've given the globe income and cover taxes also. What do you do? Add it to cover tax of which year? Absolutely. I don't think it needs any workings at all. Now let's see this one. Now Singapore, there was a tax adjustment refund of 1.4 million results in a decrease. Now let's see what we have to do. Okay, Singapore. What do you have to do? You tell me. Logically, what do you have to do? You have to recalculate the ATR, correct? So let's see. So initially, so Singapore had a tax adjustment and results in a refund of 1.4 million. Now, if I see their globe income is 4 million and their cover taxes were 350 to 500, right? So in case it's a decrease, I have to go back and recalculate. Now you see the fund. So let's say what was the original top up taxes? ETR was 8.8%, right? Now we have to recalculate it. So what do I do? Cover taxes is 350 to 500. So I'm just using dollar here instead of euro. 350 to, what is the refund? What is the refund received? 1.4 million refund was received. So 1.4 million refund was received. So what is the cover taxes which I can use now? What is my adjusted cover taxes? 1.4 million minus 352 500. So it would be negative 10,1047 500. Right? So what is my ETR now? What is my ETR? Which would be negative 1047 500 divided by what is the globe income? Globe income is 4 million. Right? So divided by dollar 4 million. What is this number? This is negative 26.1875%. Okay. Are you with me till now? Okay. Now, what would be my top up tax? Top up tax would be 15% base rate minus 26.1875%. So what would it give me? So my top up tax would be 41.1875 percentage. Crazy, right? Crazy. This is how top up tax can really rip you. So what is the tax that I have to be paying now? Tax recomputed is 4 million into 41.1875% equal to 1.1647 500 is the tax that I recomputed. Now, how much do I have to pay? What did I already pay? So my initial ETR was 8.8%. So that means I would have paid some top up tax, no? So 15% to pay is 1,647,500, which is my new recomputed top up tax, minus 15% minus 8.8% into 4 million, which basically comes to, because I already paid this since my earlier rate was down. So 15% minus 8.8% is 6.2%. So 4 million into 6.2% I already paid. So 248,000 I already paid. So 1,647,500 minus 248,000. So the top up taxes that I have to pay now is 1,409,500. You see how much my tax rate has increased? 41% because of a negative ETR. Are you clear with this example? How you will recompute? Yes or no? Yes or no? Great. Now, the third one, Ireland. Ireland, there was an R&D credit error correction. So it results in an increase of 180,000. What do you do, guys? You will add it into the covered taxes of 2027. Getting it? All this data is rubbish for me. I just add. I am not going to recompute and for an increase. Is it clear how the adjustment should be done? Hmm? Now, I saw most of your faces when I took the negative 26.1875% and recalculated the top up tax at 41%. I could really understand your curiosity, like, why a negative figure would increase the top up taxes like this. And that is why from tomorrow we would be doing ETR, the third version. So we learned, the top up thing, the numerator, which is cover taxes. Cover taxes, what were the adjustments? You tell me. Number one is you have to definition numerator. There is definition of what is cover taxes, right? There was additions and subtraction, mandatory additions and subtractions. Then there was DTAA, deferred tax adjustment amount. Then we talked of two options. What are the things that we discussed? So there was a DTA loss exemption. A lot of things we covered. I'll take you there. Once you can see my screen, right? So this was the most expansive chapter that we did. Oh my god, still not there. See, we started at 177 and now we are at 283. So that means it's more than 100 slides of cover taxes alone. So this was a hard nut to crack, but I think we did that. So basically, what are the things like, we have to define cover taxes, current tax adjustments, deferred tax adjustments, globe loss election, whether you have to take globe loss election so that you would only carry forward DTA and recast it. Others are all gone. When to choose it, when it is not worthy to choose it. You remember you told me that if it's a 0% tax jurisdiction, then it makes worth to kind of like choose the globe election. Tax allocation between entities. Okay, when it's a PE, when it's a flow through entity, when it's a similar kind of setup, then how do I allocate the taxes between the entities? We learned about CFC push downs, PE allocation, all that. Then there are post filing adjustments. Okay, so four is now officially completed. Now we will go to five, which is calculation of ETR. Now you have done numerator and denominator. We have to now calculate ETR. Okay, and so that all this explanation as to what happens if it's a negative, what happens if your globe income is zero. Okay, you have taxes but divided by zero. These situations could arise, right? So in such situations, what do you have to do in terms of ETR? We will learn in the next class. So after five, I think the thing that I have been talking about, like everything would click. This will happen after five. Till then, there would be a lot of questions and doubts. After five, things may click. Okay. Then it was all secondary things like safe harbor and all the other exemptions. But the main calculation, the line share part would end after five. Okay. So see you guys. So we may be like, on 50%, say 4 out of 8. But trust me, 3, 4, 5 is the most toughest one. After that, it's going to be like, then it's more clarity on what you already know. So it's going to be easy. Okay. Thank you and see you tomorrow.